In this video, we are talking about applying the mortar, which is minimizing your tax and maximizing your security. This chapter will be divided into 3 different sections: using tax strategies, using tax variation, and the pros and cons of using self-managed super fund as one of the strategies in buying investment property. The first that I want to talk about is tax strategies. If you are a single person with no dependent, having a salary income of $80,000 and buying an investment property house and land package worth about $600,000, you will get tax savings of $227 per week. In other words, this property of $600,000 will only cost you $80 per week, or it's only $320 per month. The second part of this chapter is using tax variation. Tax variation is when you receive your tax savings in pay cycle basis. So instead of having the tax savings coming in as a big chunk of tax refund at the end of the financial year, you receive it during your pay cycle, whether it's weekly, fortnightly, or monthly basis. We all know that banks charge interest on daily basis. This means the more money that you have in the offset account or paying the loan sooner or more frequently will reduce the debt and will reduce your interest on loan as well. The hardest part of buying an investment property is you need a lot of money to fund for your deposit. What a lot of people don't know is you can actually use super fund money to fund for this deposit. In order for you to do this, you need to set up a self-managed super fund. There are pros and cons in having a self-managed super fund. The first benefit would be it creates diversification within your fund's portfolio. The second benefit of using self-managed super fund is the tax rate within superannuation is only 15%. The capital gains tax discount rate is only 10%. And when you are retired, you pay 0% tax. The third benefit of using self-managed super fund is when you have a negatively geared investment property, this will reduce your taxable income inside the super, which means you can pay 0% tax even before you retire. When you're using self-managed super fund, there are things that needs to be considered as well. Number 1, property, just like any other investment asset, is exposed to market volatility. This means the property value can drop. Number 2, property is a non-liquid asset. It means property cannot be sold quickly. Number 3, the loan inside self-managed super fund is more complex, so you need to seek professional advice. So the key points to remember is you need to seek professional advice in claiming all possible and available deductions, using your tax variation, possibility of using your superannuation to set up self-managed super fund, prepare depreciation report for your investment property, and the last thing is you need to allow time for the property and finances to settle. And you can duplicate the process over and over again.